So you are at the correct meeting. This is build more fortified plans for 50% less capital. I'm Glenn Setchfield, VP of Marketing for DMI. We also have Maureen Walker with us today. She is our content strategist. And then, of course, Andy Robertson from CSSCS. And we really appreciate him being here. He's a great partner of DMI's. Today, after we introduce Andy a little bit more here, we're also going to talk about why 21st century retirement income planning is vital to not only your clients, but also your business. And then we're going to review a very special case study that exhibits exactly how we build more fortified plans for 50% less capital. Then we're going to do Q&A after that. And actually after Q&A, we'll also show you how you can deliver these types of case studies, but in a more personalized way for your clients. So a lot to cover. Andy, I'm going to stop sharing the agenda and actually let you get into it. But for everybody's knowledge, Andy is the Vice President of the Corporation for Social Security Claiming Strategies. And, you know, we again have a very strong partnership with CSSCS. And you'll see in some of the documentation we show you today, some of the net results of that partnership. So, Andy, we really appreciate you being here. And I'm going to just let you crack on.
Great.
Thanks so much.
Thanks, guys. Thanks, Glenn. Appreciate the opportunity to talk with everybody as always. Just remind me, how we doing for time? Because I think you guys certainly, you, Declan, Maureen, know I can get carried away. So just keep me honest here. How much time can I spend on 21st century retirement income planning without blowing up the whole presentation?
Well, you know, I think, you know, maybe we tell the short 3-minute version of the benefits to clients and businesses, and then
Sure.
And then go into the case study from there. And then during Q&A, if anybody has any questions, we can take a deeper dive.
Okay, great.
That sound
Great.
good?
So yeah, so I think, you know, I love to talk about kind of the history and how we got here. So I think I'll touch on that for a minute, and then we'll talk about what the benefit is of embracing, you know, this 21st century type approach to the advisor, the client, to the practice. I think we'll speed it up very well. So,
Sounds
you know,
good.
here we sit, it's 2023. We have, you know, more people retiring every day than we ever have had in this country. And the vast majority are trying to provide the income they need off the assets that they've accumulated, right? So we went through a watershed moment in the financial services industry when essentially the bulk of the burden for providing retirement income transitioned off the employer and onto the employee. And that goes back to 1978 and the introduction of the 401k plan. And ultimately over the next, you know, 15 years or so, defined contribution plans, or K plans, became the go-to retirement income plan for employer-sponsored vehicles and away from defined benefit plans. And that really created a tremendous opportunity. This business, I've been doing this for a long time. This business looked very different, you know, 35 years ago, even than it does today. And the driving force behind the unprecedented growth we see is that transition from defined benefit plan, where the employer was really the one responsible for providing that income, the defined contribution plan, where now it's the individual employee saving through an employer-sponsored plan. All those assets that they've accumulated across multiple jobs have to get coordinated, have to get managed, and ultimately have to deliver an income plan that's intended to replace a pension. You know, in spite of the fact that many people see these dollar figures on their statements as a massive asset that they've now accumulated, the reality is it's an income asset, right? And they're going to be forced to use it for income, whether they want it or not, because of the way it's all structured. But here's what I'd tell you from my perspective about a 21st century retirement income plan. So in 1952, Harry Markowitz introduced something called modern portfolio theory. We more commonly known today as asset allocation. And in 1952, I want you to think about something. In 1952, retirement income planning was not even a thing, right? The retirement income planning and the need for that didn't come about until the transition from defined benefit plans to defined contribution plans. So 71 years ago, Markowitz introduces modern portfolio theory, asset allocation, and it's focused on growth investing. Now, here we are 71 years later, a tremendous opportunity has been put before us as an industry, right? And the responsibility is we've got to turn around and figure out how to help these people who are now responsible for funding their own retirement plan. And we're trying to convince them by and large that asset allocation is something that was created for growth investors, could also double as an income planning strategy. And what we have right today is across the industry, we're being told by academics that the vast majority of Americans are underfunded. And why are they underfunded? They're underfunded because when you use an asset allocation approach, which was a growth strategy masquerading as an income strategy, you need 2 times more capital to do the job than you would need if you used an asset optimization approach, which is our 21st century retirement planning strategy. So the value of a 21st century retirement planning strategy is you can build better, more fortified plans for 50% less capital. What does that mean for the client? We can take the bulk of them who academics consider underfunded to fully funded, and in many instances overfunded, and create an environment where we can free up X amount of dollars today to do better, more productive things while they're alive, like legacy planning, gifting, things that not only protect the income plan, but protect the asset and pass the asset to the next generation. What does that do for you, the business owner? It's going to create more revenue off the same dollars. It's going to create deeper relationships, and it's going to create ongoing relationships as by way of acting as a bridge to the next generation. When you deliver to this next generation, they're essentially their inheritance intact, while their friends, family members have seen their inheritance evaporate because they did not build a plan properly. That's going to be a huge differentiator for you and your practice with the next generation over everybody else. But really, it acts as a differentiator today. You can position yourself as a retirement income specialist by leveraging our certification, the Corporation Social Security Claim Strategy certification, improving using our tools quantitatively that you can do, as I said earlier, build better, more fortified plans for 50% less capital. So it's great for the client, it's great for you from a revenue perspective, and it's great for you from a retention perspective. And all of us are going through the same thing. We're going to also look to not only retain clients, but retain the next generation, because maybe our children are getting involved in our business. But it's a true differentiator across the board. It makes you the go-to person as the retirement income planning specialist in your community. So that's the focus of what we do philosophically. And it's all built around this idea that we haven't evolved as an industry, but we need to, because the needs of the people that count on us have incredibly changed thanks to that transition from defined benefit plans to defined contribution plans.
Well, that's a great treetop. You know what, Andy, one thing I just wanted to set up, like I did in the promo, is to think about the costs, like upfront. So where we're going to go is we're going to explain where we come up with these costs. So we're going to compare some plans, right? We're going to compare 3 plans. 2 of them take a traditional strategy in mind, and one takes the 21st century plan in mind. Could you just walk through the costs of those different plans and how a consumer or client is likely going to react to those? If you don't mind, set that up before we go into the case study.
Not at all. And you want me to refer to the numbers that are in this case study that we're going to cover next? Yeah,
and they'll have to just bear with us, guys. We'll show you where the numbers came from. Right now, we're going to throw a few numbers around, but they all come from real calculations, and we've taken some Morningstar type calculations into account here and that kind of stuff. So
sure. So what we're looking at is, and I've mentioned the term quantitative a couple of times, but what we're looking at is we're taking these opportunities and saying, all right, the vast majority of Americans are essentially considered underfunded. But the one thing that nobody talks about is literally all of these research projects that have come to that conclusion indicate that they expect everybody to take Social Security benefits early. So that's the assumption they used in their actual, research work that provided us with this outcome. What we're going to look at is, are there ways, are there strategies that could change that? Because right now, for the typical person, when they reach the doorstep of retirement, if they haven't accumulated enough money using what we'll call a traditional retirement approach, then they only have a handful of options. They can keep working, save more money, right? Maybe take on more risk, but in the end, I think we all agree that may create more problems than solve problems. And then lastly, the other thing they can consider is having a lower, kind of expectation retirement around income and lifestyle, or they can look at leveraging some of the tools in the retirement planning toolbox that have often been overlooked. And that's really what we're focused on as retirement income planning specialists. And we look at it, and we look at it at any case study and say, how does, as an example, taking Social Security benefits at different times impact the amount of capital it requires to fully fund a retirement income plan? So when we talk about cost, you've heard Glenn use that term cost, we're really talking about how much capital do we have to commit? Because at the end of the day, whether people want to view it that way or not, that's really what it is, right? Any assets they have in qualified plans, they're going to be forced to take them as income, whether they want them or not. And the question is, how can we minimize the amount of capital we have to commit to the income portion of their retirement income plan, and therefore free up other capital to do other, as we said, more productive things? But to give you an idea, we're looking at one singular case study, and I'll just talk high level as Glenn said, from a cost perspective. And we're saying, look, if I took benefits at this time and I used an asset allocation approach to deliver my income, how much capital would it require? And it would require, in the work that we've done, it would require $1.65 million. Well, how much less would I have to accumulate or commit or budget if I took Social Security benefits at a different time? Well, just taking Social Security benefits at a different time alone will reduce the amount of capital you have to accumulate by roughly $430,000. So we made a $430,000 pivot in the other direction in favor of the client, and it didn't require us to get lucky with picking the right stock, the right bond, the right crypto. We didn't have to get the right sequence of return, right? We just leveraged one of the other tools in the toolbox that's typically overlooked. But then we can turn around and say, okay, we've kind of zeroed in on the impact that Social Security can have and optimize that. What else can we do to take that cost down one step further? Well, now we can introduce the most economical tool to deliver guaranteed lifetime income benefit available in the marketplace today, and that's a fixed indexed annuity, right, with a lifetime income rider. And we do that in this case study that you'll see, we drop the capital requirement or the budget or the cost to $716,000. So we reduced the amount of capital someone would either have to commit or accumulate if they were behind the eight ball. We've reduced that number by $900,000, just over $900,000. And all we did was take a different approach to how we went about tapping into Social Security and delivering the income. So the power of 21st century retirement income planning is you can take a lot of people who are convinced they're underfunded, because that's what the media has been telling them for 20 years, and show them that whether or not they're underfunded has far less to do with how much they've saved and far more to do with who they work with. And you want to be that person they look to say, that's the person I want to work with. That's the person who can build me a plan within the budget I've been able to accumulate, with the savings rate I've been able to keep up with, not the person who says, no, you need twice as much and throws it back on you and leaves it up to you to make a tough decision about what you're going to do in retirement. It doesn't have to be that way. And you'll see as we go through the numbers in more detail, Social Security is really the one last opportunity you have as a financial advisor to save what may otherwise be, using a traditional approach, asset allocation, a doomed retirement income plan. It doesn't have, the outcome that they're seeing doesn't have to be the outcome. If they simply work with the right people, they get the right advice, and they leverage all the tools, not just some of the tools in the toolbox.
Yeah, wouldn't it be nice to have your client coming to you and saying, what do I do with all this excess income? Right? I mean, I think that's what we want to get to, right? Before you go into the case study, I just wanted to mention, because I didn't at the top, if you guys have any questions, just use the Q&A or chat function, and we'll pick up on those questions at the end, but feel free to throw those at us. Yeah, go ahead, Andy. I didn't mean to interrupt, but that was great.
Well, no, but you raise a great point that I haven't touched on, Glenn, which is, there's really a couple of options. Once you go from underfunded, where you have limited options, overfunded simply because you're working with a better professional who leverages all the strategies, you have excess capital. And one of the things you could use it for, to your point, is more income. You'll never have somebody say, no, that's too much income. I don't want any more. You've given me too much, right? They're hoping, whether they admit it or not, that they have enough. Most are avoiding the conversation until they can't avoid it anymore because they're convinced, thanks to the media over the last 20 years, that they're probably going to be in a bad way. The good news is when they come and speak to you, they're going to find out not only are they not in a bad way, they're in a great position if they're talking to the right person like you. But that's a great point that you make, Glenn, which is you could one opportunity that presents itself when you do it this way is more guaranteed income. And if you don't want that, we'll just take that excess capital and we can do Roth conversions and we can split the assets and put some of it in like long-term care or life insurance with long-term care and protect the plan, and then take the balance and through the power of leverage, replace all the money for the next generation on a tax favorable basis through the power of life insurance. There's just so much more you can do. You can take the additional income and just funnel off the income, to pay a life insurance premium. So it's amazing how you completely change the paradigm from being underfunded and really having to live a very, kind of careful retirement to overfunded. And now we can not only deliver the income, we can protect the income, we can protect the plan, we can deliver all the other things that they went away. I don't believe that clients don't care about legacy, which is what I hear from other advisors. I think they've given up on it because they've been bombarded with messaging from the mainstream media for the last 20 years that says, you'll be lucky if you're not a burden to your children because of what's going on in the market. So when you deliver to them, I can speak this firsthand, when you deliver to them a plan where not only is their income plan fully intact, fully inflation adjusted, highly tax efficient and guaranteed, but there's $500,000 of capital now we can say unequivocally we can use for something else, you've got their attention. So on the case study, does everybody have the case study? We sent them a PDF and we can just kind of walk through it, or do we want to put it up on the screen?
You want me to share it or have you got it right there? Or
if you want to share it, I think that would be great.
Okay, I've got it.
I printed it out and made some notes on it.
Here, let's see here.
Fantastic.
Can everybody see that?
Yeah.
Okay, perfect.
Yeah.
I'll let you walk through it, sir.
Yeah, so Maureen really has worked really hard with Glenn's help to kind of take this message and package it in a very simple kind of view. But what we're talking about when we talk about 21st century retirement income planning is taking that typical, mass affluent client that we all want to work with and say, let's look at their situation and from a quantitative perspective, prove that doing it our way is a significantly better approach than doing what we call the traditional way. So the goal of this couple, we've got James and Erin, like most couples, they've saved all their lives, they're getting ready to retire. They're thinking about using an asset allocation approach. They're going to put 60% of their money in equities and 40% in fixed income, and they're going to use a systematic withdrawal from that portfolio to close any income gap they have once all their what I'll call their guaranteed sources of income kick in. Now, of course, most people, as you all know and have experienced, are predisposed to taking benefits early for a whole host of reasons. We're going to, through our process, get them to look at reasons why they may want to consider delaying. Not everybody should delay. It really comes down to which combination of Social Security benefits, your assets, and other income strategies is going to deliver the income plan for the least amount of capital possible, because that's the way we maximize the likelihood that the plan is successful and create the opportunity to do other things with the money. So in this case, we'll look at the same fact pattern, but we'll look at 3 different scenarios. So we're going to assume they're both 66. You'll see at the bottom right assumptions. They intend to retire at full retirement age, which is 66 and 6 months. They have primary insurance amounts of $3,200 and $2,800. So remember that primary insurance amount is the retirement income benefit at full retirement age. If they opt to take it prior to full retirement age, it'll be less. If they wait, it'll be more, but that's the number that's most critical to understand and to build out any case. So the PIAs are $3,200 and $2,800. They have $127,647 projected income need at age 70, and $101,950 is projected to come from Social Security by the time they're 70 if they take benefits at 70. So I'll talk more about that in a minute. Ultimately, they end up with a $25,697 income gap at 70, and we have $925,000 in which we can position to close the income gap. Now, the whole premise of this case study was Morningstar published a position paper where they said, and I'm essentially quoting, if you have 36 times the income gap in a retirement savings account, the annuities provide little to no value. So essentially what they were saying is, if you have 36 times the income you need on an annual basis when you retire from your assets, annuities they don't really bring much value. They don't do anything for you. So naturally, we wanted to take a look at that and say, that really is kind of counterintuitive for us. Let's take a look at that and see if there's any validity to their position. So the first thing we're going to do is on the far left in these columns, you see early. So the first thing we're going to do is say, well, what if somebody took benefits early? Because that's what most people do. And we'll consider early, for our purposes, FRA. And they use a traditional approach. Traditional, for the purposes of our conversation, means an asset allocation approach. And they're going to use 60-40 asset allocation model to deliver any income gap that remains once the Social Security benefits kick in. So as you look at this piece and you look down that column, you'll see that, and I'll draw your attention to the Social Security piece. Social Security is going to deliver 68.4. The annual income gap, therefore, would be 39.6 to get to the income goal they seek at FRA. And they have just over the 900 and some odd thousand, just over the 26 times. They have $1 million in retirement savings. And the question, that we wanted to answer was, given this strategy, taking benefits at FRA and using your assets to backfill any income gap or any income shortfall, do they have enough capital? And one of the things we look at is, to answer that question, we say, well, how long do we want the income plan to last? We say 30 years. What do we want the probability of success to be? We want a 95% plus probability of success. Based upon that, we can back into what the capital requirement is. And you'll see right just below here, the capital requirement is $1.645 million. So if they move forward with this plan is underfunded using an asset allocation approach. This is what most people intend to do. And this is why all the researchers say the vast majority of Americans, 70+%, are underfunded. It's not because they haven't saved enough money. It's because they're committed to taking benefits early. And you'll see that as we go through this. So what we want to explore, again, kind of testing the Morningstar hypothesis, is, well, what if we took Social Security benefits early? Will that play a role, right? And again, using the same approach, we're going to retire at FRA, but we're going to delay taking benefits until age 70. Then once the Social Security benefits kick in at 70, we're going to use an asset allocation model to fill any remaining gap. Well, I'll draw your attention down here. So we projected Social Security is going to provide 87,545 of the total income dollars needed. So the balance, the 22,301, is going to have to come from the capital, right, that we have. And we're going to use that to close the gap. Well, the reality is there's one added dimension here. If I'm going to retire at FRA and not take benefits till 70, there's another piece that we have to account for in our analysis, and that is the bridge capital, which is the money they're going to use out of their retirement savings to carry them from FRA until 70. And then from 70, when the Social Security benefits kick in and deliver the 87,545, we need enough to close the remaining gap after the higher Social Security benefit kicks in, and that gap is 22,301. So between the bridge capital and the amount of capital needed to deliver the additional 22,301, the amount of capital required would be just over $1.2 million. So certainly taking benefits later has provided a benefit to this couple. It's taken them from needing 1.65 million to needing 1.22 million. They go from underfunded by 650,000 to underfunded by 222,000. But again, just like virtually everyone that they put through these analyses, they're still underfunded. The question is, are they underfunded because they haven't saved enough money, or are they working with the wrong strategy? Again, Morningstar is telling us that the $1 million, which is more than 26 times the income gap, should be more than enough. Well, the truth is, as you can see right here, it's not. And we arrived at our conclusion, the $1.2 million, using Morningstar's initial safe withdrawal rate. So looking at their own research that they published prior about initial safe withdrawal rates, they can't pass their own test. They need $1.2 million. They only have $1 million. And yet this recent hypothesis says, yeah, if they have 26 times, they'll be fine. Not the case. What about, they're better off certainly, but what about if we not only optimize the Social Security, but we optimize the assets that are available to provide income? And the way we do that is to take advantage of the one solution that's available that provides a benefit of leverage. And that's, again, a fixed indexed annuity with a lifetime income benefit rider. What can it do from a client perspective to address the question of cost and drive down the capital required? Well, here you go. By the time they take benefits at 70 and they have the annuity benefit kick in, the numbers are the same, right? It's 87,545 from Social Security. So 22,301 has to come out of their capital. They still only have $1 million because we're projecting, right? There's 66 now. We're projecting based upon the numbers we have in front of us. And we turn to our friends at DMI and say, by the way, how much do we have to put in the annuity to deliver the additional 2231? So instead of using an asset allocation approach, how much do we have to invest in annuity today to deliver that 22,301 for the duration of 2 lives on a guaranteed basis? We take that number plus the bridge capital and the total capital required if we use this 21st century approach, which is all about leverage, leveraging Social Security and leveraging the assets you have. We deliver the income plan for $716,000. So the cost, as Glenn referred to it, is less than half of what it would have been had they gone forward with what most people do, which is take benefits early and fund the income gap with an asset allocation approach. Not only that, there's a couple of other things here that are worth pointing out. So not only do they go from underfunded by $650,000 to overfunded by $238,000, but this plan is much more tax efficient. Only 45% of the income plan is considered taxable. That's before standard deductions. So this couple would be receiving roughly $10,000, a little over $10,000. Actually, it's $9,000. I'm looking at my numbers a month in income, and they owe $125 in federal income tax. So not only have we delivered this plan on budget, but rather under budget, but we're delivering it with an incredible amount of tax efficiency, and it didn't require any kind of, financial planning gymnastics that we typically see when we want to introduce some kind of tax efficiency. It's just a tremendous byproduct of a plan that's more heavily weighted in Social Security versus a plan that's more heavily weighted in fully tax invested IRA dollars. So that's an added benefit. The survivor benefit goes from 38.4 to 71,449. Think about how much more capital you'd have to have on hand if you went forward with this strategy to match the survivor benefit that you have under the optimized strategy. I mean, it's literally $33,000 more. How much capital would you have to have remaining upon the death of the first spouse just to match the guaranteed survivor income? You all know the answer. If we're looking at delivering an additional $30,000 a year, and by the way, this is assuming no COLAs, we're going to need, somewhere in the neighborhood of, depending on their age, $750,000, $800,000, $900,000 in remaining capital. They're not going to have anything this short, as we looked at here. So the capital is less, the taxes are less, the survivor benefit is more. And not only is the survivor benefit considerably higher, but they're also going to be able to tap into the future value of any excess capital. So remember, we went from underfunded by 1.65 million, right? We need 716,000 to actually deliver the plan. We have $283,000 of excess capital. If we grow that at just 5% over 10, 20, and 30 years, look what the future value of that may be for that surviving spouse. So the surviving spouse is not only never going to have to worry about running out of income while they're together, but when they're alone, they've got a survivor benefit that's greater than or almost 2 times what it would have been, and they've got all the future value of the excess capital. And it's worth noting that all we did was leverage all the tools in the retirement income planning toolbox a little better. There was nothing, there's no tricks, there's no smoke and mirrors. It didn't require any luck. It didn't require any specific stock picking, bond picking. We simply were better at delivering retirement income plans because we're specialists than the other people that we compete against. So hopefully, guys, I've hit on the high points of this, but this really lays it out bare, left to right, what people are historically doing on the left, what they should consider doing, which is delaying, and what they really ultimately want to embrace, which is a 21st century optimized plan, and what the value is for doing that.
Yeah, it's great, Andy. Thank you so much for laying that out. I just wanted to add that if you want to stand out from the competition by adding annuities and Social Security knowledge to strategically build better, more fortified retirement income plans for 50% less capital, you want to get licensed with DMI and get engaged with CSSCS. We're offering a discounted CSSCS class that's administered by Andy Robertson. We also have potential reimbursement for class costs. And then we also have ongoing mastermind classes to hone your knowledge even further. And then also, I just wanted to share something with you guys. It's a real big value add, I think. We've built together with Andy, and you can't get this anywhere else, a do-it-yourself marketing campaign that includes a PowerPoint presentation that you can use with future clients. Here, stand by 1 second. Here we go. So this is something we call our Social Security Complete campaign. So everything in here is completely customizable. So essentially, we've got a 4-week campaign with emails that are customizable, social posts, broken out week to week. You just do what the PDF here, the dynamic PDF here, tells you to do. You download these assets, plug them into your email client and into your social media. We've also got webinar invitations included in those assets, and we give you recommendations on how to follow up. So obviously, the follow up is key. And then, when you're ready to do your either live webinar or a live workshop or online webinar, we have a PowerPoint presentation here for you to use with script notes and everything you need to pull off that presentation. But to get the most out of that, it really helps to have the CSSCS education, and it certainly doesn't hurt to have the CSSCS title next to your name. Just a little side story. I'm the VP of marketing, and I recently had a friend of mine over for some barbecue, because here in Texas we do a lot of barbecuing. And I got to telling him about what I had done with the CSSCS, because I went through the program myself. And after about 30-40 minutes of talking to him, and I actually cheated and I went back through my guide that Andy had written up for us, and he was like, "Wow, Glenn, that was incredible. Like, I feel a lot better about my future just based on this conversation. And I'm not a financial advisor. So, and I was very clear on that with him, but I felt like I was sort of like put in a different place. I had a different level of credibility in discussing that with him. So imagine what you guys could do with it. So I just wanted to share that. So, I would also say, in the next couple weeks, either on the 21st or the 28th, we're also going to do a webinar around the Athene Retirement Optimizer, which is a calculator that we use to make a lot of these calculations that Andy's showing you today. But again, it helps to have the CSSCS certification to make those calculations and to understand it and be able to explain it. So with that, Andy, I don't know if there was any final thoughts that you had. I know we've got some Q&A and Maureen's chomping at the bit to get to it. Was there anything you wanted to add, sir?
No, I think we hit all the high notes. We have some questions. I can respond to the questions, and I think we're in good shape. If you want me to just jump in here, Maureen, and start looking at some of these questions, I can. You may have answered some of them, so let me know. I'm not sure that I'm reading this the right way, but one of the questions was, what about real world situations that do not fit this particular case study? People take early retirement where they may need money from early 60s to supplement income needs, so on and so forth. Absolutely. So one thing that's worth noting is this was a very unique case study that we created specifically for the purposes of testing Morningstar's hypothesis, right? So these are effectively the numbers that they used in their write-up. We had to back into them, but this is the only way they could have arrived at the numbers that they arrived at. But what I can tell you definitively is the Athene Retirement Optimizer software that Glenn referenced a moment ago is set up in such a way that you can look at every situation. And the ultimate bottom line that we're trying to get to is, can taking benefits at different times and introducing an annuity change the amount of capital somebody's going to be required to commit in order for the plan to be successful? Because that's the crux of the whole thing. If the number one concern is the threat of running out of money, then it stands to reason we need to figure out how to build the plan within their budget today so that later we're not depending on a bunch of things that are out of our control. As somebody said to me earlier today, hocus pocus, things that ultimately we're relying on, but we have no control over. So to answer your question, every situation is different, as you know. That's what you're portraying. The software will tell you exactly how much capital is required to do it one way versus the other way. And you can explore all that in the software. So if you have somebody that's going to take benefits early, maybe once they get to where they want to go, maybe they want to delay benefits from FRA and beyond to recapture some of the growth that they lost. So there is no limitation on really what we can look at from a planning perspective and figure out. Very rarely, I must say, do we find a situation where we can't help somebody build a better plan. The next one that really speaks, not everybody maxes both Social Security benefits. Absolutely. And frankly, when we see somebody that has two spouses that have high Social Security benefits, they're also the ones that want $125,000, $150,000 in retirement income. We also meet a lot of people where they have half what this couple had in primary insurance amounts. Maybe one spouse has a full Social Security benefit and the other one has a half a benefit. Well, their income needs tend to be lower as well. So it's all kind of relative. But hopefully that makes sense. The money, there was a question about where does the money come from during waiting period. So as I was saying, we call that the bridge period. And we calculate in the software exactly how much money you'll have to use to carry yourself and cover any shortfall that may exist, right? So to your point, every situation is different. You may have a couple that's not the exact same age. One's going to retire at one age, one's going to retire at the other. We're going to backfill whatever we need to backfill during this, what we call bridge period. And the bridge period is defined as when the first spouse retires and the second spouse takes benefits. When the second spouse takes benefits, at that point, we can quantify exactly what the permanent remaining income gap will be. And now we can figure out what do we need to satisfy that income gap from that point going forward. Between when they retire, when that happens, we call it the bridge period. We calculate bridge capital. So you heard me mention in the total dollars, we included bridge capital. That's how we calculate that. It's all built into the software. Survivor benefits are based on the benefit value that the deceased was collecting at the time of their death. So in this instance, we're talking about if they wait to take benefits till 70 and someone passes away, they're going to get to keep the greater of the two benefits. And in this instance, both benefits were age 70 benefits. But no, you're not relegated just to, you said FRA, I think you mean PIA. You're not relegated just to PIA. You're going to collect whatever the higher of the two benefits are at the time of the first spouse's passing. And that may be an age 70 benefit. You know, in a lot of instances, if we're doing our job right, that ends up being what it is. And that's just an added benefit. The dollar amount for the guaranteed survivor benefits that was showing in the 60-40 plan, the only dollar amount we can reference is guaranteed, of course, in those asset allocation strategies is the Social Security income. We cannot suggest that there's some kind of guaranteed survivor benefit made available from the balance of the assets which are being managed in the capital markets. So where we get that guaranteed survivor benefit in those two plans is it's the higher of the two Social Security benefits at that time. So that's the answer to, in the two 60-40 plans, where do you get the dollar amounts for guaranteed survivor benefits? It's the higher of the two benefits that would remain, and that's the number we plugged in there. I don't know if there were any more. Do you see any more? I think I got them all. So, you know, these are great questions, and they're the kind of questions I like to see because obviously, you know, you guys are thinking through this and you're looking for, you know, where the holes are because you want to understand it. It would be great if you could come on the Athene Retirement Optimizer demo that Glenn mentioned. I'll run that demo. We'll take a deeper dive. We can even go through this case. We can go through other cases. But I can promise you this. It may appear as though we're saying everybody should wait till 70. It's really not that simple, and there is no rule of thumb. The only rule of thumb is plug in the fact pattern, and we'll tell you, the software will tell you which strategy is the optimal strategy, and the optimal strategy is the one that requires the least amount of capital. I had one the other day, husband and wife, 10 million plus in qualified assets, 10 million plus in savings, a portion of that, which was qualified assets, and a $350,000 income goal. The only form of guaranteed income they have currently is Social Security. By the time we were done, the optimized strategy was for them to take benefits at 65, just based upon how old they were, when they wanted to retire, the income level they needed. When we put all the pieces and parts together and tallied it up, 65 was the number. So it just depends. It isn't always 70, not even close. And you know, certainly Glenn and Maureen, you've seen this, and Declan, you've seen this as we've continued to build cases. It's always, I don't know. And that's exactly why you go through it. And it's a game changer because it's all built out in the software. All the supporting calculations are right there in black and white. So the Athene demo session, Glenn, you're going to send out a communication to the group as a follow-up and let them know when that will take place?
Yep, absolutely. And then we've got much more. I mean, we have a CSS/CS class coming up in July as well. Actually, Maureen, when's that CSS/CS class? July, I think it's late July.
July 24th is a Tuesday at noon. We'll be hosting Andy again for the CSS/CS certification, followed 2 days later with a very specific ARO class directly featuring everything that everyone just learned. And that class on Thursdays, a much shorter class. It's only like an hour.
And those and those are directly related to the certification. So you have to get licensed with us, and then we get you registered through Andy's organization, CSS/CS, and get you trained. There were some other questions, Maureen, that might have been sort of more general in nature that are kind of repetitive. You want to cover some of that stuff, like regarding the presentation and stuff?
Absolutely. Within a few days, I will be sending out the presentation that we're listening to right now that we just saw, as well as the case study that we looked at on screen. I'll be sending you the PDF. So you'll always have access to that. And then anyone can reach out and email Declan is a great person to talk to as our BDR for the company. There we go. This is Declan's contact information, and he would be the go-to person if you're interested in the CSSCS certification webinars that are coming up.
Yeah, I believe Declan is CSSCS certified himself, correct, Declan?
Yes.
Yeah, so Declan's been great. I mean, he really understands the topic, and a great person for you to speak to about it. And then he can get you in touch with one of our VPs of sales, get you licensed, and get you onto Andy at CSSCS. But man, we really appreciate all the engagement today. We had a lot of questions, a lot of great questions. And Andy, fantastic to have you. Declan, Maureen, really appreciate y'all being here. I think that's it, guys. So we will follow up with you after this meeting. Thanks again for being here.